Australia's banks may have to look offshore for growth in the post-global financial crisis world. That's the view of the Reserve Bank, which says that domestic expansion is limited as demand for credit slows. Andrew Robertson reports.
Australia's banks have had mixed success with their foreign forays. At the moment, NAB is struggling with underperforming subsidiaries in Britain, while ANZ is making an aggressive push into Asia. But overseas might be the place to be, as the domestic market offers limited future opportunities.
There isn't any corporate loan growth at all, and residential lending growth has been as weak as it's been for probably 30 years. So if you want to get back to the levels of growth that they once had, of the order of 5 years ago, there is no alternative but to look offshore.
The Reserve Bank agrees. In its semi-annual assessment of the financial sector, it notes that it appears unlikely that credit growth will return to the very high rates that were sustained in the pre-crisis period. It concludes that in an environment of slower domestic credit growth, banks may look to expand overseas. As for the health of Australia's banking system, the Reserve Bank's Stability Review has confirmed what everyone already knows.
Australian banks are in good shape. They came through the crisis profitable and well capitalised. They've strengthened their liquidity positions and their use of deposit funding.
And the RBA is tipping a period of earnings growth in coming months. The outlook for profits is favourable, given that bad and doubtful debt charges are expected to continue to decline in the period ahead.
6% as a general major bank industry number is about the level that we're looking at for the next year or two, and that's on the back of credit growth, at least for the next 12 months, of the order of 4%. So you should get higher earnings per share growth than you have credit growth because of the reduction in the bad debts.
It's a point highlighted by Westpac boss Gail Kelly at a major financial industry conference in Hong Kong. Mrs Kelly told her audience Westpac's impaired loans are on the way down after the dramatic run-up during the global financial crisis. But there are potential storm clouds. The Reserve Bank's Malcolm Eadie noting that as the damage from the GFC recedes, other uncertainties are appearing.
The tragic events in Japan are a new element in that picture, as is the instability in North Africa and the Middle East. It's going to take some time before the implications of all that can be assessed.
Dr Eadie was speaking at a conference in Sydney which was reviewing the new Basel III global financial regulations, which are aimed at preventing a repeat of the global financial crisis. He says tougher rules won't be enough on their own.
We need bankers and investors who don't take silly risks, supervisors who are prepared to ask tough questions and step in when they see excess, and good quality implementation of the rules that we already have.
As Malcolm Eadie was speaking, the government was revealing it will allow banks to hold up to 8% of their total assets in covered bonds. It's something the big banks will no doubt be pleased to hear, particularly as in its Financial Stability Review, the RBA says they're considered the safest form of bank debt.